Ladies and gentlemen, welcome to the webinar. Today's seminar presentation is Setting the Table, Preparing Your Business for Sale, Even If You're Not Ready to Sell. Today's presenters are Gary Forster and Kathryn Jones. If you'd like a copy of today's presentation, you'll find it in the handout section of the webinar interface. And now, without further ado, I'll hand it over to you, Gary and Kathryn. Go ahead.
Hello.
Hello.
Go ahead.
Hi, everybody. Thank you for joining us today. I'm going to go ahead and put the voiceover on. Today's seminar topic is kind of a prequel to some of the seminars that we've given in the past. For some of you who may have listened in on our LLC operating agreement seminar or our private equity sales seminar, that's kind of where this leads up to, is how to get your business poised for sale from a record keeping and documentation standpoint. A lot of times this is kind of seen as an ministerial or administrative task. You know, business owners are busy doing everything else they need to do to run and operate a business. So as lawyers, we often are confronted with a situation where a client may not have kept corporate minute books up to date, or there's a whole host of documentation issues that we're trying to wrangle on the eve of a sale. So in this seminar, we'd like to kind of give a heads up as to what things a business owner could be doing along the way to make that process a little bit less arduous and overwhelming when it's time to sell.
Also, when it's time to sell, if you look like you've been working on the company for several years to make sure it's going to merge well or fit well with a huge buyer, it's a credit to the seller, and it will speed the sale substantially.
Absolutely. So our agenda for today are these 5 broad topics: the overview and introduction. Next, we'll talk about statutory record keeping requirements in Florida. We'll focus mostly on corporations and LLCs because that's what we see the most of. Understanding that there's other entity forms out there. If there's any questions about partnerships or other forms that were not covered in this seminar, please feel free to email us, and we'll be happy to take a look at that for you. The third item is the due diligence checklist, kind of a broad overview of what a buyer is looking for when they are evaluating a business. Item 4 is going to be a deeper dive into some of these key areas of inquiry. And last, we'll reserve some time for questions and answers. We covered this a little bit earlier, but again, I think point C here is worth repeating, is that when you're preparing your business to sell, the buyers will send over checklists, which could be dozens of pages long and very overwhelming. And so having well-maintained records and accessible records is going to make the process a little bit less painful, and also a little less expensive when attorneys are brought in to handle due diligence and respond to requests. The better organized and maintained the documents are, the quicker it goes, and the less expensive it typically is to get past that phase.
So let's set the scene a little bit.
That's right.
You have a business. You've been working the business for several years. Maybe it's an intergenerational business. You've been doing the same kind of accounting. You've been doing the same kind of corporate record keeping for years. Some of that may be inadequate. So what we want to do is not only satisfy, for instance, with corporations, you actually have a statutory record keeping requirement with respect to who owns shares, how that's accounted for, what your bylaws look like. There are actual requirements to maintain, to keep the corporate form. The corporate form basically allows a business to operate, whereby if operations have no impact on shareholders. So for instance, the corporate form takes both a legal and an accounting perspective. From the legal perspective, corporations are required to maintain minutes. We'll go into some more detail with that as the seminar goes on. Basically, you should have a share journal reflecting both stock options and shares held in the company and how those were transferred. What documentation was used regarding the transfer? What happened when Grandpa died and we got the company? How did we document that? 70, 80% of the time We didn't document
didn't.
that. It just didn't happen.
Right.
So these are the kind of things that are going to trip up a seller and create a huge expense and a fire drill when they want to get the company sold. It would also, by the way, it's very expensive in terms of it will whack away and reduce the price you'll be able to get for the company, because if it's messy, that'll just be another excuse for the buyer to lower the price. That's the corporation. The LLC is a little more flexible, but what happens with flexibility is you don't have these constant record keeping and document requirements in the statute, but that means you've got to do it yourself. You've got to create your own rules. So what happens if someone leaves? What happens if someone is fired? What happens if there's a separation? What happens when notes get paid? When owners, die? When family members decide they don't want anything to do with the business? What happened in grandpa's will? Who do you give the stock to? This stuff is just a menagerie of issues. And when they're all going to get fleshed out? When you want to sell. All those issues are going to get fleshed out. And as we go through, Kathryn's going to go through a lot of the warranties and representations that the shareholders make. Sometimes they're like, well, we're shareholders, but we don't know exactly how much we have. These are all huge problems with respect to the sale of the business. The accounting side is similar. It has to be very tight, the accounting, because the price of the company is going to be based upon net earnings. And a lot of times these companies don't really even know what their net earnings are. Cousin Joe and my daughter and her two baby dolls are employees of the company. Well, if employment's going to create salary, and salary is going to reduce net earnings. Well, now instead of getting 5 times or 8 times that salary as a part of net earnings, you don't get anything for it. It goes away as an expense, or it becomes a bargaining chip for the buyer. That's the accounting side, but they really kind of blend the accounting and the law on this. And what we're talking about now is having a clean, crisp due diligence process instead of having to go through a year of getting the company cleaned up and looking bad when you're trying to sell it.
Gary mentioned earlier the formalities and record keeping requirements in the corporate statute. So Florida corporations are governed by Chapter 607, and we've cited the record keeping statute here. And in the following slides, we've actually copied the actual text of the statute. I'd like to just kind of point out use of the word shall, going back to that requirement that it has to be done when you're in the corporate form. So in this subsection 1, this lists the documents that have to be maintained by the corporation. We'll go into a little bit further detail on the articles of incorporation and the bylaws later in later slides, but note section D, all written communications within the past 3 years to shareholders generally or to shareholders of a class or series. In these smaller family businesses, there may not be a lot of formality in communications and how they're recorded and archived, but it is a requirement to have those types of records accessible if you're in the corporate form. And we'll also talk about a little bit later annual meetings and the requirement to hold annual meetings when you're doing business as a corporation.
By the way, there are a lot of other problems with doing business as a corporation that are not part of this seminar. We probably want to move toward LLC if you're a corporation, because of the flexibility and the protections offered by the LLC. It's just something to keep in the back of your mind. It's I'm not sure it's more attractive or not. It's probably neutral in terms of being a seller, but in terms of operating the company and protecting the assets, it's much better, the LLC.
We're just showing the additional documentation. Subsection 2 talks about financial statements, reports, and then there's also a requirement to maintain a record of your current shareholders. And here's where this kind of dovetails into what Gary was mentioning earlier, is that when you have these smaller companies, there's not a lot of formality. You may not have documented adequately the trail, I guess, of ownership of the shares. And so one of the reps and warranties that a buyer will expect from a seller is that you produce the current list of shareholders, that there are no liens or encumbrances on the shares, and that you can kind of produce a clean paper trail as far as documenting who owned what at what times.
Because you know that someone who is a minority owner, if you just kind of let them float off without getting documentation and they find out about a sale for 10 times earnings, they're going to come back and want to
Absolutely.
check. We've dealt with that a number of times.
Sometimes in the absence of corporate documentation, what companies may be forced to rely upon are K-1s and tax
It's
records
evidence.
as evidence of
yeah.
ownership, which may not necessarily line up perfectly with the legal ownership and titling of the shares. We see that in litigation oftentimes is, our litigators, they'll have a shareholder dispute and, we don't know who owns what. And so all we're left at looking at is how they've treated it for tax purposes.
Exactly.
The Articles of Incorporation, this is one of those documents that has to be maintained and updated as part of the corporate records. Here, there's a list of what the substance of the articles must be, and this is a document that's filed with the state to form the entity and create it legally. And so whenever there's a change in these kinds of items, you'd have to submit amended articles to the state and file them of record. I wanted to point out here subsection C, which is the number of shares the corporation is authorized to issue. You don't have that requirement in the LLC format or the LLC Articles of Organization. So where this kind of comes into play practically is if a corporation decides it wants to recapitalize, they want to create a new class of shares or increase the number of authorized shares they're able to issue, you'd have to actually file an amendment to the Articles of Incorporation. It's not really that huge of a deal to do that, but if you go ahead and enter into shareholders agreements or other,
but people don't do it.
They don't do it. Exactly. So you may have a situation where somebody may have privately contracted to issue a new class of shares, but they haven't laid the groundwork to create the class of shares of record in the Articles of Incorporation. So that is something to be careful of. Again, that's not an issue that comes up in the LLC context because there is no such requirement, but for businesses doing operating in the corporate form, that is a pretty big distinction. Another set of documents are the bylaws. The statute says that the directors shall adopt initial bylaws, and that sets forth the voting mechanics, meetings, notices, things like that, which again, they're, a lot of times they're somewhat boilerplate, but they do need to be adopted and maintained.
Yeah, a lot of people confuse the bylaws with the shareholders agreement. So what Kathryn mentioned is a requirement by law that bylaws be drafted and maintained and voted into effectiveness pursuant to a statutory requirement. More important in many ways is the shareholders agreement. So the shareholders agreement is going to be the contract between the owners. And for instance, when someone leaves or no longer works at the business or dies, there's a mechanism by which the remaining shareholders or the corporation can buy them out. The same is true for LLC equity, which would be called an operating agreement. And well, I can't tell you how many times, I don't even know how many times you find that, for instance, there's one dominant shareholder or member in LLC, and there was equity issued, like let's say there was a 10% equity issued to an employee who's no longer with the company, right? The employee has been gone for 2 years, but the employee has the equity. Many people don't understand who have these companies that even if someone's terminated from employment, that equity doesn't go away. We've had huge real estate deals governed by corporations, which is idiotic, but it happens all the time, where you have a minority member typically who doesn't contribute to, let's say the property required some kind of development and it was $1 million and the majority shareholder paid the whole $1 million. it doesn't mean that the minority owner is going to be out of their equity. So now you have this issue, even to the extent we've had a number of times where the majority comes to us and says, I need the money, I need the 10% as part of the, I need 100,000 so that they contribute their proportionate amount. Well, there's no shareholders agreement. Do they even have to pay it?
Right.
Do they even have to pay? So we can talk about these requirements all the time, but you also have to keep in mind the need for shareholders or an operating agreement, because when it's time to sell, these issues come up. Well, if there's hair on it, we've got to clean this up. All these issues, this old employee that has equity X, Y, Z, before we're going to even look at it. Because I can tell you, the wave in some ways has passed in many areas, but this private equity, in other words, you have a general sale, a strategic sale to someone in your industry, or you have these private equity funds that are buying up different industries. And the strategic sale, you could be flexible and work a lot of things out. It was someone in your same industry. But these private equity deals, because they pay so much, or they did, they won't take any risk. I mean, when the review starts, the due diligence starts, it's basically a full accounting audit and full legal due diligence. And they won't really even get started with many of the documents until a lot of this stuff's cleaned up. If you've got a floating, minority shareholder out there who used to work for you 10 years ago, that's going to have to be resolved.
Another issue with the shareholders agreement is, oftentimes you use them to restrict the transfers. And so if you don't have something like that in place, the shareholder could pledge the shares for collateral for an unrelated loan or something out there that could lien the shares or sell it to somebody else. And so we actually had a deal that kind of, the buyer was looking to purchase shares in a company. They did their early due diligence and found that there was a lien on the shares. And so that kind of put the kibosh on that. They found it early on, but and I think that's kind of why they do the due diligence so heavy duty before they start putting pen to paper, is to kind of flesh out or
some of these private equity deals, the buyer will spend $1 million on the accounting. I think the $1 million had a lot to do with the fact that it was so hot and everyone was so excited and it was in such demand for these accountants. But they would spend $1 million on the due diligence. Absolutely crazy.
Right. Going back to the statutory requirements, corporations are required to have annual meetings. Again, this is something that may fall by the wayside when you've got, a 1 or 2 person operation. But technically, you're supposed to have annual meetings, or where you would elect the directors. You can either meet in person or do a written consent in lieu of a meeting, but something has to be documented in the records as to who the current directors are.
Not a requirement of LLCs.
Right. LLCs. We've clipped the pertinent portions of the statute here for you. I mean, there is a list of things that an LLC has to maintain, but it's not nearly as, I think, formalistic as the corporations. You don't have to have meetings. There are things that you will want to have in place even though they're not required. Again, the operating agreement, if you have, you should have one. It's not required by statute, but you definitely should have one for many of the same reasons that we talked about with respect to a shareholders agreement. So here, here you'll have to keep the tax returns and financial statements, and subsection F down here. This sometimes falls by the wayside as well, is where you need to keep a record of contributions of property to the company or other it's cash or whatnot.
Capital contributions.
Capital contributions. You're going to want to have to maintain a record of that. Item 3, we're moving on to the due diligence checklist, and here really it's the buyer's deep look into the seller's business. They're basically no stone unturned, or at least that was the practice that we've seen with private equity firms. Again, with strategic buyers are already familiar with the business, so they may not be as risk averse, but we have seen more often than not that the buyer will send a due diligence checklist that's dozens of pages long, and then we are helping the client navigate what has to be produced and producing it in a way that is organized, and will facilitate the buyer's quick review of the documents. So we've listed here kind of the main areas that we've seen in our practice as to what the buyer will want to look at. Item 1, the corporate governance, that's most pertinent to our discussion today, and we'll talk about that more. And as well as the other items here, we'll get into a little bit more of a deeper discussion.
Yeah, and as part of this, if you have a business and you're considering selling it, you may want to think about what format you would like to sell, and in what format you would like to sell the business. So you should get with your tax attorney and your CPA and determine what is my tax impact of selling assets versus my tax impact of selling the whole company, the corporation, or the LLC that holds the assets. And if you're going to come to a conclusion on that, there's also some options whereby the buyer may allow you to sell the company, but the box, but it's actually taxed as an asset sale. And there's a lot of wiggle room in between, and if the buyer saves tax, if you save tax, is that going to affect the purchase price? Do you split the value of the tax savings in the purchase price? This type of thing. It's something to think about, but it's very related to the preparation of the sale, because if the company is a mess, if the accounting's a mess, or the corporate documents are a mess, your options in terms of the format to sell are going to decrease. Because what happens is the buyer can come in and say, okay, I just want the box. It's the easiest for us. We're going to buy the box, and it's going to become our subsidiary day one. They love that, okay? But they're not willing to do that. And typically that's the best tax result for the seller, because you likely will just selling your shares or your LLC equity, and you're going to get a pure capital gains lower rate than the ordinary rate. There's no recapture of depreciation. It stays inside the box, this type of thing. It's usually very advantageous. The other side is the buyer, if the buyer's scared of problems, they're going to insist instead that the entity sell the assets, in the business assets inside the entity. So if the buyer comes along and says, you know, this is kind of a mess, you know, I don't really want to deal with your cousin who claims he may be a shareholder, you know, it looks like you've got a lot of, you know, internal loans and shareholder, you know, lending and debt and this kind of thing. It looks like you've got issues with, you know, possible supplier liabilities or something like this. But then they go and say, okay, but we want the business, so we're going to buy all the assets and leave the debt inside the entity, and we're going to do a public lien search. So we do a public lien search. There's a couple of small things. We'll take care of that, but we're going to buy the assets because we don't want to deal with all the kind of messy transactions that this company's been involved with. But what's happened? What's happened is it's a slightly more complicated transaction, number one. And number two, you now don't have the option to sell the stock or the LLC equity, which may have been a substantial advantage to you tax-wise. So what we want to do is we want to clean up all the corporate governance documents and all the accounting now, so that you have the option. Because I can tell you what happens is they almost always go, we've done hundreds of these transactions, they almost always go, the buyer will almost always insist, I should say, on an asset deal and a clean public lien search if anything has raised its head, and you won't be able to sell the stock.
I mean, there is an exception, I guess, for certain regulated industries where keeping licenses intact is paramount, particularly in healthcare where there's an EIN. You want to keep the EIN.
You can't, there's a huge delay in switching. But what does that do? That puts even further pressure on the seller to get everything cleaned up. Because you could actually blow the deal at that point. If they don't want to try to reapply for new licensure and insurance coverages, health insurance coverages, they just won't. They just leave it alone. They'll just walk away from it. if it's too much of a mess, because they don't have the option, or it's too cumbersome to buy the stock.
And these the groups, they're typically looking at more than one target. So if you have 3 or 4 targets you're looking at, and one's got clean books and records, and it seems to be a relatively painless due diligence process, they may just go to that one, or they may pay a premium, or there are
or pay you a huge discount.
Exactly.
Because they want you, because there's nobody else in your state that does what you do, or nobody else selling, at least. But we're not going to pay you that money because this is a mess. It's too much risk.
Right. Okay. Here we've covered this a little bit, so I'm just going to kind of skim through this. Again, keeping your corporate documents organized and accessible is going to be very important, because in addition to making them available to present to the buyers in due diligence, they're going to want a certificate of manager for LLCs, or a certificate of secretary from a corporation, where a corporate officer or director or manager in the LLC context is going to certify that the documents are accurate, complete, valid, and if it's a mess, it's going to be very hard to make that certification and to pull those documents together. Again, shareholders agreements we talked about a little bit earlier. These are a list of things that the shareholders agreements can address. Typically, the buyer is going to want to see what's in place, and see if they're if the corporation, or in the LLC context, the LLC has papered exit plans, and how to get owners out when they're no longer active in the business.
So probably of all of the documents, there should be a shareholders agreement and an operating agreement. And this is true in both contexts. That the corporations, we hardly deal with corporations really anymore, but really have bylaws as well. So bylaws deal with voting, a board of directors, how shareholders vote, etc., quorum issues. That is all now encapsulated in the LLC operating agreement, whereas a corporation has bylaws and a separate shareholders agreement, sometimes referred to as a stock restriction agreement. An interesting shift that occurred was Florida and many states adopted the corporate law, the shareholder law, from the old English law of the 19th century. And that was very encumbered in certain ways. In other words, shareholders agreements were kind of required because there's a rule that you can't stop people from selling their shares, the rule against encumbrances. So that's why, if you have public shares, for instance, you can always sell your shares if there's a buyer. Well, you don't want that if you've got 4 partners and they're in the boat together, and you want to restrict someone from being able to just walk out to their neighbor and sell their shares off. So that's really drives shareholders agreements. Also, when someone dies, do you want the spouse to start voting those shares, depending on, it could be a minority or majority position? Do you want to lock in a board? Do you want to make sure these are the people that run the company, no matter who we issue shares to? This type of thing. If you move to the LLC operating agreement, which I noted encapsulates voting also. So you have voting and equity issues. But here's the thing with the LLC. The LLC is not subject to the rule against encumbrances. So where in a shareholders agreement, you can say, okay, we don't like the rule requiring that everyone can sell their stock whenever they want, because it's a mess. We have to, what do we include? We restrict that by saying if someone wants to sell their stock to an outside party, we have the first right of refusal. We can buy it back. We don't want someone from the outside coming in. Same is true if someone dies. We want to buy the stock back from the estate. And a lot of times what we do is we put in life insurance so that the liquidity occurs, the corporation has the insurance proceeds and uses those proceeds to buy back the stock. In LLCs, we also recommend having buyback rights. but they're not as significant because there's no rule, at least in I believe, well, there's a Uniform Limited Liability Company Act, which kind of plays with it, but there's generally no rule against encumbrance. So you can actually put inside your LLC agreement that you're not allowed to sell. You just can't sell your interest. You know, if you violate that and you assign them to somebody, the person basically is buying an assignable interest, an assignment of income that may be due associated with that equity, but the recipient cannot vote. So the issue associated with locking down shares and creating a right of first refusal is not as significant. It still should be written into the document, but you can, you know, especially in a family or related company business or an investment situation, you can just lock up the shares, which are called membership interests. And all this occurs in the operating agreement.
It's a great segue, Gary. Thank you.
There it is. And there it is. There's your slide. I didn't even know what's coming.
So we've got, once you have an operating agreement in place that kind of walks you through all these restrictions and what happens when someone leaves, you want to amend and update it periodically when there's a shift in ownership. Members join, members leave, even if the same people are involved. If ownership percentages shift, let's say you've got somebody who had a control position at one point and then they went to a minority position, you may want, from that perspective, you're going to want to amend the operating agreement to build in protections for that person who is now a minority member. We talk about this a little bit more in our prior seminar, which we've linked below, as to how to protect a minority member in the operating agreement. And so oftentimes people, when they do have an operating agreement drafted, there's a lot of time spent putting it together, and then it's kind of shelved, and then it's not pulled back out when certain things occur with respect to the company. So whenever there's a shift in members, or you want to recapitalize the company, let's say you want to offer a new class of units for investors, you're going to have to amend your operating agreement to create that class of units so that you can then issue them to the new people coming in.
And also, what's interesting about the LLC, you could do this with a corporation, but it's very cumbersome, is that, you know, grandpa can start to shift out equity in an LLC, but it's all subject to the operating agreement. And a lot of times people are surprised by the idea that they can shift under 50% in ownership, but retain control through the operating agreement. And everyone signs the operating agreement, and everyone agrees that you know, grandpa or dad or mom or grandma, you know, are remain in control, even though they now own less than 50%, even down to a few percent. Now, the case law has not tested this at the, you know, when the matriarch or patriarch gets down to 2 or 4%. So another side issue with respect to selling and making sure that the people are in control, that the buyer thinks are in control, is if we start issuing to the next generation, or we start moving down under 50%, that we can have non-voting equity and still retain our S election or whatever our tax election is. We can also issue to the younger generation in trust. Those two things eliminate any doubt with respect to control, which really facilitates and smooths the way to a lot of planning, such that if the company's worth $1 million today, but we think we're going to sell it in 2 years and we're going to clean it up, but we're going to get rid of a lot of equity at the top generation, it really eliminates any doubts and concerns that we're going to lose control to Jimmy, because Jimmy was that grandkid who was always off on his own. You know, we don't want that. So Jimmy's going to take in trust, and then we're going to sell. But when we sell, we're going to sell for $40 million, and then all of the shift in value goes out to trusts for the next generation. but it's already out for estate and gift tax purposes at the $1 million level. It's another thing to think about. This due diligence process raises a huge amount of issues, and I'm trying to provide you a feel for what's going to happen as you start to clean the companies up.
Another kind of layer in this is if your entity is part of a conglomerate structure where, let's say, you've got a holding company and several subsidiaries that handle different lines of business, the buyer is going to want to see documents for each of those affected subsidiaries that are part of the conglomerate. So if you've got 4 or 5 subs within a holder, you can multiply the last couple slides by 4 or 5 times as far as getting documents together and organized. The next area that we commonly see buyers asking about is management and key personnel. I wanted to hit on the employment agreement and engagement documentation a little bit, in that, again, going back to kind of an informal family business, you may not have written employment agreements between dad and the business, or Jimmy, or whoever is providing services. And if a buyer is coming in, they're going to likely want to see a formal writing to set forth what the employment duties are, the compensation, any kind of bonus, profit sharing, or incentive plans. In the healthcare industry, typically part of the background check process is checking if a provider has been suspended or excluded from state or federal healthcare programs. All that would be documented in your employment intake if you've got a healthcare business. But again, what we're trying to do is kind of explain how informal relationships, while they're working when it's a smaller business, really need to be formalized as you tee up a business as part of the growth and an eventual sale of the business.
Yeah, and you mentioned this incentive plans. We've been doing a huge amount of this work because you have these minority owners, those potential minority owners who are employees or children or whatever, typically employees, really. And you're thinking about sale, and you don't want to complicate. You don't want to create a fly in the ointment with a minority owner who's going to have to approve a sale with actual equity. When you issue equity in a corporation or an LLC, you actually give up what are called shareholder rights. And any owner, whether it's 1% or 0.5%, has the right to an accounting. They have a right to see the books and records, and that kind of stuff comes up when you announce that you're going to sell the company. To avoid that, we create these compensation plans where that same employee, instead of getting actual equity, just gets a percentage of the sale, a percentage of the net proceeds of the sale. It's a contractual right. There's no shareholder rights. So there's no intrinsic right to get an accounting, to see all the documents, to, this type of thing. And it's very popular for people who think they have a sale that's coming within 2 or 3 years.
Item 4 here, this comes up frequently where if the business is needing a cash infusion, sometimes the owners will forego salary or distributions to keep the cash in the company for growth, or they may even loan money to the company. A lot of times these are informal arrangements that are not documented. And so what we'd recommend is that, kind of with the end goal in mind is to prepare a business for sale, is to use like loan documents or formal writings to track how much money is being lent to the company or foregone a salary distribution, because the buyer is going to want to see what's owed to the shareholder at the end of the day and what's going to be expected to be repaid. And so you may have a situation where an owner may forego $5,000 here or salary here, and it's kind of piecemeal. And so when we're brought in, we typically are asked, okay, the buyer is going to want to know, well, what kind of intercompany loans are out there? Is there anything intrinsically between the owners and the business that's owed? Or and so if you have a loan document or something clean that sets all that out, it's much easier to educate the buyer as to what's out there and what would need to be repaid. In addition, buyers often look at third-party loans, banks, guarantee agreements, anything that where a company, the targeter, if it's a conglomerate, any subsidiary within that company, that umbrella holding company, has guaranteed to pay a debt. And so again, UCC liens come up. Sometimes the debt is paid, but the lien may not have been released of record. And so when that happens, a good practice would be to pay off the loan and then do a UCC search maybe a month later to make sure the bank has released it. You don't want anything floating out there.
Nothing. And it's also a leverage point. I mean, these credit facilities, depending on the size, can be the most complicated transactions themselves. A lot of these loan covenants and terms require certain cash to be in the company, require liquidity, they require certain limitations on salaries. I got to tell you, typically they're in breach. The companies are not perfectly complying with their line of credit or the facility, and what happens is the seller, the owner of the company, has to figure out, okay, how do we get back into compliance, because we're either going to have to pay this thing off or we're going to have to get a consent from the lender to the sale. And if you get the consent, now the lender is going to come in and check to make sure all of our covenants are in place, which are not. And it's like another 2-month delay in the transaction. These loans can be a huge problem.
And usually, if you're going along and you're paying your debt, the lenders might not even.
They won't know, but you'll be in breach.
Yeah. One of the reps and warranties that are given in the purchase agreement is that you're in compliance with your loan covenants, or you've disclosed
exactly
that you're not in compliance, and you've explained to the buyer kind of where the warts are in these loan documents. And so again, just kind of keeping an eye on things as you go, and not waiting till a sale is imminent is going to aggravate a lot of stress, or it's going to alleviate a lot of stress and aggravation. Real property, in a situation, we commonly see our clients, they may have a holding company structure where one subsidiary is used to operate the business, and a separate subsidiary under common control owns the real estate that is being used in the business. In a situation where you've got common ownership like that, you may not have a written lease formalizing the arrangement, because ultimately it's all controlled by the same few individuals. When a buyer comes in, they often want to see a written lease put together, maybe on the eve of a sale or in conjunction with the sale. And so we'd recommend that even before you kind of have a buyer, in mind, to have these lease relationships formalized in writing. In addition to cleaning it up for a buyer, you have an asset protect. The advantage is the more arm's length it looks, the better. If you're treating the entities separately,
and sales taxes paid and everything,
it's less likely that somebody could come in and kind of
an interesting fact that we've basically learned over the years is very few of these buyers, the larger the buyer, the less interest they have in the real estate. So what's going to happen is, as long as it's a clean lease currently, they're going to ask you this separate subsidiary, this real estate subsidiary, to sign a new long-term real estate lease. As long as things are clean, it's really a beautiful transaction, because you're getting a huge purchase price, and then you're just leasing your real estate at a market rate for a long period of time. I've never seen that go poorly. It's really great. And then you have your next debacle here. Sellers, individual owners may also own the real estate. Well, that's a separate entity. But the debacle is if, in fact, the real estate is owned in the business entity, right? So if the real estate's owned in the business entity and you want to sell the business entity, you've got to send the real estate out, right? So then you go back to, is our line of credit secured by the real estate? Is there a separate real estate loan? If so, now we have a taxable documentary stamp transaction. Have we, how are we going to do that? Are we going to get a new loan? Are we going to move it out? Do we have to get lender approval? A lot of the lender approvals are then going to be linked to the real estate, and then we're going to have to get it out to a new entity. Otherwise, we were talking about asset sales. You can leave the real estate in the current entity, right? And move all the business assets out. It's a more expensive, typically tax-wise transaction to the seller, and all your covenants on your real estate part of your loan are going to get clipped. And then you have to get lender approval. And what does that lead to? A whole new real estate loan package. And you'll have to negotiate a whole new loan for your real estate triggered by your sale of the business. So that's real fun. Gear up for that if your real estate is inside the same entity that you operate your business. We've done that. That was fun, wasn't it?
Yeah, it's always fun when you've got like 18 different issues you're dealing with,
And
and
then
you're closing next week.
we had to do a whole new line, right?
That's right. That's right. So bottom line is, if you do own the real estate in the same entity as the business, the best time to kind of plan is when you're not trying to, when you don't have an LOI out there. So this is kind of a dormant time for the business. You're kind of stable. Let's look to reorganizing, so when it does come time to sell, we're not having to deal with this along with the million of other issues that come along with just the sale of the business. Intellectual property is kind of analogous to real estate in that if you have a multi entity structure, you may own intellectual property in one company, that's your holding company for the IP, and then you lease it to the operating company. A lot of times this may not be formally documented in a license agreement, so you're going to want to have license agreements in place between commonly owned companies just to document the rights that go with the use and what the restrictions are and how those licenses can be terminated. One of the reps and warranties that a buyer is going to want to see is that the target that they're acquiring owns all the IP that is required for the business or has a valid right to use the IP pursuant to a license agreement that is compliant and there's been no breaches and is clean going forward. So you want to make sure that your IP, if it is, you want to be able to document ownership or a right to use the IP. Another area that we see that maybe not so formal in a smaller business is protective agreements, confidentiality and non-disclosure agreements. Again, when it's a small form, family-owned business, there's a lot of trust there, but somebody could go astray, and you want to make sure you've got documents to protect the company.
Well, the buyer won't allow it.
And the buyer will not allow it. The buyer is going to want something because they don't have that familiarity. They don't have that.
Better to have it in place and negotiate changes than have the buyer create the new document.
Right. And in Florida, that has to be in writing. So even if there's an understanding, it's if it's not in writing, it's not going to be enforceable. Tax compliance. This is a big area of inquiry for a buyer. And here, just file. We've seen a situation. It's kind of interesting where a client may have paid the tax either through estimated tax payments, but they haven't filed a return. And so we have issues there where if you don't file your federal income tax return, the statute of limitations doesn't start to run. So normally you file it. There's a 3-year statute of limitations that the IRS has to examine the return and assess additional tax or whatnot. That 3 years goes up to 6 years if there is a substantial understatement of income on your tax return. Again, if you don't file, the clock doesn't start to run. So, if the business is non-compliant for years as far as filing is concerned, that's open. That's something that the IRS can do what's called a substitute return. And that if you don't file and they catch on to it, the IRS could take income information from third-party sources, piece together your income, which is going to be gross income, and then tax you on that gross income amount. And so what happens is the taxpayer wouldn't be able to take deductions or exemptions that would ultimately lower their tax burden.
Yeah, they create a return, but you won't like it.
Right. And so you want to make sure that, you file, you get the statute of limitations running, and there's no overstatement of your tax liability if the IRS were to create a substitute return. Because
also once a substitute return is created and you fail to file, the cost of dealing with the problem goes up geometrically. Now you're in administrative litigation. You know, instead of just filing a return, now you've got to engage us to deal with the IRS. It could take months to get the thing squared away, and thousands of dollars of fees.
And again, when you have a buyer in the wings, that's not the time.
No.
You want to have that done and clean, so you can give that rep and warranty that you're compliant with tax obligations. Kind of a practical tip is to order tax transcripts from the IRS once in a while to make sure you're okay. You can order transcripts directly from the IRS, and it'll show you, you know, the history, if there's been any assessments or liens or anything that could be a blemish on tax compliance. It's a good idea to order those. State tax compliance. We talked a little bit about the federal. On the state side, the Florida Department of Revenue has certain ways to create leverage if you've not paid your sales taxes, for example. Number 2 here seems to be a pretty, it's a heavy hammer in that if your business is serves alcohol and has a beverage license, one of the first things that the DOR will try to go after is your license, your liquor license. And so we've had a situation in the past where this is kind of, you know, basically shut down a business because they can't, you know, they can't sell the alcohol. And so just keep your state tax filings compliant, and make sure you don't have any issues there. Buyers also look at litigation. So you're going to want to keep records, obviously, of claims, pending or threatened claims, inquiries from regulatory authorities, and settlement documents. Again, this is one of a number of things the buyer is going to want to look at. And also, if you have these issues, you're going to want to disclose potential litigation or pending litigation so you don't breach your rep and warranty.
We're good. Yeah, we're
good?
starting to wrap up.
All right.
Yeah.
And regulatory and license matters. Here, we do a lot of healthcare transactions, and so part of the diligence request will ask about filings or investigations by medical regulatory authorities, as well as confirmation that the licenses and permits are
right.
current.
And with healthcare, we do healthcare, a lot of foreign transactions, a lot of general business. But the healthcare, if you don't have the licensure right, it will substantially delay the transaction. They're in no hurry to deal with it.
Right.
And the buyer will not close.
Right.
We have a couple questions. You guys want to take some questions now?
Sure.
Okay, so can you elaborate on the benefits of carrying over the EIN?
For healthcare or for non-healthcare?
That's all I have.
Well,
Why don't you tell us for both?
Well, Kathryn had mentioned for healthcare. In other words,
healthcare is what I just got the response.
Oh, healthcare, yeah, because what happens is, depending on the type of business, for instance, if it's a provider entity, all the provider insurance reimbursement contracts are under that federal ID number. Also, there's Medicare issues, and the state licensure, they call it a CHOW, change of ownership, all relates back to that federal ID number. So what happens is the buyer is going to be motivated to purchase the entity which owns the federal ID number. And if the buyer buys the entity, all the regulatory, all the accounting, all of the, you know, the basic substantive issues and assets have to be in line and perfect. They can't buy the assets out. You can't buy someone's federal ID number. So they're required to buy everything in the box, and which makes the due diligence that much tougher and the prep that much more important. Do you have anything to say about that?
And also just, you know, when the buyer is motivated to purchase the entity and the box to maintain the EIN, in the purchase agreement, you can get really complex with indemnification in that they will contractually want to apportion liability as if it were an asset sale and not an equity sale.
Mhm.
So what you'll see is a buyer, if they really want to keep the entity intact, but they're concerned about issues with the operations, they may hold back some funds. They may require an indemnity escrow to be established where they're going to hang on to that money for 18, 24 months
Yeah, and
after
if there's a
closing.
real, sometimes there's a real doubt. There's a real doubt as to whether someone's in compliance. And we've had a couple. Then we had one, a smaller deal where it was a treatment facility, and they had changed the law, and no one was really in compliance, and this group wasn't in compliance. We had to work it out. It probably delayed the damn transaction for 60 days or something, and all that. But they had to take the entity because they wanted a federal ID number.
Okay, another question here. Can you talk about the creation of a stay bonus?
A stay bonus. So if you stay a certain amount of time, so you have an employment agreement, and in that agreement says we're going to provide you a bonus, but only if you're here on January 1, 2026. That's a stay bonus. So if they stay, they get the bonus. If they don't stay, they don't get the bonus. That's similar to some of this phantom equity that we were talking about on one of the slides, where someone could become a shareholder, but it's really only for economic purposes. So if there's a sale, we're going to motivate you. If you're employed at the time of the sale, you're going to get a piece of the sale. That's like a stay bonus.
Okay, and then I have a follow-up on your previous answer about the EIN. So the insurance panel and Medicare reimbursement may transfer to the buyer if the EIN is in place. Is that correct?
Yes, if you do the proper ownership transfer. There are other licensure issues, but the reimbursement's going to be based on the EIN. Oh, thanks for attending. We appreciate it.